Christmas came early for many Canadians again in December as the Bank of Canada hit that pause button, and especially for Canadians with variable rate mortgages, this is really a good sign as we're starting to get a lot of indication that the Bank of Canada is anticipated to cut rates at some point in 2024. And obviously, what does this mean for the real estate market? What does it mean for mortgage rates here in Canada as we're also seeing a lot of these fixed rate mortgages come off their highs as we start to see this retreat in the bond markets? And more importantly, what does it mean for Canadians who are on the sidelines right now looking to get out there into the market? What types of product, what type of information should we be looking at? And that's what we want to talk about on this week's episode. So once again, welcome back. It's Friday, Finance Fridays, and I'm your host, Anthony, with InTouch Mortgage Solutions. And once again, if you are new to the channel, we welcome you to the channel. We invite you to subscribe, hit that notification bell so you can stay up to date with what's happening, obviously, in the real estate and mortgage marketplace. Now, should come as no surprise, earlier this week, the Bank of Canada obviously hit that pause button. And this is very good news for a lot of Canadians who are holding on with that variable rate mortgage, especially as we end off 2023. This was the final rate announcement to end off 2023. Now, the next rate announcement will be in January, and obviously having that conversation about what the Bank of Canada will do next as we await in December the current CPI numbers, those inflation numbers for the month of November, which obviously will be the data point that the Bank of Canada will be looking at. But some of the data points that are really pointing the Bank of Canada in the position to really have to hold these rates and potentially cut them at some point, as many economists, including one from CIBC, Benjamin Tal, even David Rosenberg, these individuals are obviously pointing that the Bank of Canada is definitely facing some major headwinds. So what are some of these major headwinds? Well, obviously we've seen unemployment tick up to 5.8%. We have a job market that still remains pretty resilient, but it is not creating enough jobs to meet the needs of all these new to Canada individuals. So we're obviously going to see a lot of pressure mounting in this particular segment. What is also important is what is happening with business sentiment. That is coming off significantly. Now, obviously, over the last little while with all these big sales happening for like Black Friday, Cyber Monday, sure, sales were going to tick up. It tells us a little bit about the state of the economy, but I'm pretty sure that a lot of Canadians were putting off a lot of these big purchases. Maybe they didn't buy anything at all. They couldn't afford to buy things, or they were really waiting for certain items to really go on sale. And we're definitely going to see how this plays out as we start to get closer to these particular numbers. What is happening with consumer sentiment? We can say that GDP, or the growth in the economy, is definitely contracting. Some economists are saying, hey, maybe we're going to avoid a recession. Maybe we're in a recession. I believe we are, especially when you look at real estate prices, you look at unemployment, you look at Canadian spending, the amount of household debt in the system, it is getting really high. And this is something that most economists are pointing to as the catalyst that could cause a lot of pain for many Canadians, especially if interest rates remain elevated. Now, remember, interest rates are the driver of real estate. If interest rates come down, home prices tend to go up. And if home prices tend to come down, the catalyst is usually interest rates going up. This should not come as a surprise to many Canadians. This is obviously the barometer that many use. Now, obviously, with the Bank of Canada meeting earlier this week, they didn't have a press conference. They did release a statement. And for the first time in probably a very long time, we heard from the Governing Council, Governor Tiff Macklem, whoever's issuing this report, that the economy is finally not in excess demand. And this actual statement tells us a lot about what the Bank of Canada could be looking at next. Now, remember, on the channel, we've talked about the language that the Bank of Canada is going to use. The Bank of Canada just cannot come out and say, hey, we're going to cut rates at some point, right? They can't really do that, even though they would like to, or maybe they wouldn't want to signal that to the markets in an effort to try to keep Canadian spending down, make sure that inflation, once again, doesn't rise. It doesn't get back up. And we start to see things like what happened in the late 70s, right? When the Bank of Canada, the US Fed, thought inflation was dead and gone, and they reduced rates, and all of a sudden, boom, inflation popped back up. So remember, the Bank of Canada is going to be very cautious in their language. They're going to keep maybe their policy rate as high as they can for as long as humanly possible. They're not going to reduce those rates. And even when they do come to the point where the Bank of Canada will have to cut rates, we're not going to see massive rate cuts. We're not going to see them like 50, 75 as we did on the way up. On the way down, it might be more gradual. We might see a quarter, at a time. We might see, this projection of 150 basis points, basically a 1.5% cut in the overnight lending rate, which is now at 5%. So some are saying, hey, we're going to sit at 3.5%. That is a significant move. You have some economists that are predicting, like David Rosenberg, that, hey, we're going to see 200 to 300 just based on the severity if Canada enters this recession, if job losses continue to rise. Now, this is the key caveat for the Bank of Canada is when unemployment hits a certain level, if we don't have enough jobs. Obviously, what's happening with the banking system, right? Obviously, this is very important. There's so many different moving parts, and a lot of economists will pick on certain things, but I think if we look at the economy overall, we have been experiencing these higher rates for longer since March of 2022. As of March of 2024, which is quickly approaching, that will be a 2-year window that we've seen higher interest rates. Now, that's not to say that all these interest rate hikes that we've seen from March of 2022 have not felt or been felt by Canadians in the economy. There's still a lot of pain from these higher interest rates that is to come. But that is going to be potentially put off for some Canadians with mortgages when fixed rates are starting to fall. Now, what's happening in the bond market is very, very important, right? We're seeing a lot of these fixed rate mortgages fall down from where they were, just in October, November, where we're sitting with most rates in the 6s, high 6s, some even with a 7 in front of it. And now we're starting to see things come off significantly. And obviously this road, this trajectory is very hard to determine where these fixed rate mortgages will end up in the next few months. This is obviously causing a lot of analysis paralysis for young individuals, young families looking to get into the market. But what we can say is if history is correct and things repeat themselves, we can definitely see that home prices may remain stable. We're not seeing a massive influx of homes hit the market. We're seeing obviously a lot of distress in the condo market, especially in Toronto. A lot of these individuals who purchased homes, these condos, maybe they were for investment, maybe they're for people to live in. Yes, there's some major problems. We see a lot of pressure on the housing market. A lot of young families, a lot of families who purchased homes in the last little while, especially in the last couple of years, maybe they are finding financially difficult to maintain that home. And due to the circumstances, the fact that home prices have not accelerated, they've come off, they've stabilized, they've dropped in certain markets, they're not able to sell their home, recoup some of their money. It might cost them more than what the equity is in the home to sell that particular home, especially if they didn't buy with 20% or more down. So we have a lot of pressure there. We have the Bank of Canada coming out saying, hey, excess demand is, not in the system. We're still going to be very vigilant. We're going to monitor the situation, going to be data dependent. But many economists are saying, hey, look, the Bank of Canada is done. The next moves are going to be pauses or rate cuts, unless by some hand is played and inflation starts to ramp up. Obviously that is going to be another variable. We're going to have to see how that plays out. But as long as core, medium, and trim CPI begin to stabilize and come down, which we have seen trending, and we'll see what happens on December 19th, and we'll have an update then as well. So make sure you're subscribed to the channel. But thinking about all these things, obviously it's very important to understand what is happening in the mortgage marketplace, what we see happening, right? We can talk till we're blue in the face about all these particular things. We're going to hear from all these particular individuals commenting, saying the housing market needs to drop, it needs to correct. Obviously, we do need a little bit of a correction to get some more Canadians that have been waiting on the sidelines into the market, but we just don't see that happening. I just don't see it coming off enough to actually move the needle for a lot of Canadians, right? When you look at the average and medium home prices, they're coming off $20,000, $40,000, $50,000. That's significant. For some others, that's not enough to move the needle, right? Especially if interest rates remain slightly elevated. Remember, we have to qualify mortgages here in Canada at the contract rate plus 2%. So let's say even that 5-year insured mortgage is 5%, you're still qualifying at 7%, right? So these are still some of the headwinds that are being faced by many Canadians. And then if we take that sentiment, we shift it over to the existing mortgage marketplace. Those are the Canadians that already have mortgages. Well, what's happening here? Well, obviously we have this major concern around what has happened with the mortgage renewal cliff, right? So as these mortgages begin to mature and they hit their renewal dates, when that mortgage cycles back into a new term, whether it be 1 to 3 or 5 years, they're going to be anticipating a much higher rate. And the longer this draws out, obviously the more challenging it gets. Because remember, if you got a mortgage in 2020, depending if it was early 2020 or late 2020 into 2021, well, that interest rate would have been significantly lower than someone who got that mortgage maybe in 2018 or 2019. And the shock itself when that mortgage comes up for renewal is going to be much greater. And we've talked about this on the channel. We said, look, interest rates, fixed rate mortgages are going to do a lot of tightening. This is now something that has come out even in the US, right? There's a major difference between what happened in the US and what's happening here in Canada, especially when it comes to mortgages. In the US, there's a lot of Americans who have mortgages, and we've talked about this, but they take on a 30-year mortgage, right? So that means that mortgage, when they take it on at 2 or 3%, that's for 30 years. They can't port that mortgage over to a new property like you can here in Canada. Here in Canada, mortgages renew much more quickly. And that is a major catalyst, what we've been talking about, the two divergent economies. We have the US, which is obviously much stronger, more robust, especially when you look at consumer spending, you look at growth, GDP, their numbers are up, right? But even the US Fed is talking or potentially talking about a potential rate cut in the future, where Canada is basically in a position right now where, hey, we may need to cut rates further than the US. And yes, this begs the million-dollar question. What happens when the spread between the US and the Canadian overnight policy rate, what happens when these rates begin to widen, is obviously the US dollar importing inflation. But it's very important to understand that the US and the Canadian economy are two different economies. Although they were dependent, Canada's dependent on the US, we have to look at what's happening right here at home. And if we enter a recession, or if we are in a recession, or how severe or how deep this recession gets, how unemployment gets impacted, that is the key driver. How big of a number are we going to see in the unemployment sector? Is it going to be over 6%? We're trending that way right now. And if Canadians lose their jobs, obviously they can't afford to pay for their mortgages or for their rent. And this is going to be an ongoing problem. So this begs the question, as I said, we talk about home prices, we talk about how all these things are playing out. One key thing is if we enter a recession, okay? And this is where I say to consumers, you have to be very cautious on the direction, what you're listening to, and you should never be forced into a decision to purchase a home if you're not ready, right? So you have to be financially ready. You have to understand, hey, how secure is my job? What is the longevity that I have in it? And, am I looking to make a move into the market? Because if you're thinking about it, if a recession comes and people start losing their jobs, the last thing people are, when there's uncertainty and the sentiment in the market is weak, is they're going to be jumping into the housing market, right? This is a reality. So even if interest rates come down, but there's an overarching fear that I'm going to lose my job, I need to save more money just in the event that something happens, well, that means that there's not going to be a lot of people jumping into the housing market. I'm not saying everyone's not going to jump into the housing market. There are many Canadians, there's a lot of new to Canada individuals that make really good money, have really stable and secure jobs. They got a ton of money to put down, and they're ready to buy a home, right? They're ready to start a family. And this is the key thing, is people are not speculating at this point to buy a home potentially as an investment. That might come much more further down the pipeline. Right now, the individuals that we're talking to, they're young individuals who are looking to start a family. Maybe they're renting, they're getting kicked out, their landlord's trying to sell. Maybe that is the situation, and they're looking to get into the market to purchase their first home. They're not buying it as an investment, right? We have a lot of individuals that are looking to buy and move up because they just need to find the right home for them. We have many clients that are in that situation, and if they're able to keep their existing home for the market to turn over, and then they're going to sell it, well, that's something that's happening as well, right? So there is a lot of division in between how people are perceiving what is to come. Some are very optimistic, some are very pessimistic about what is happening or what is about to unfold. And this begs the question, obviously, when you're thinking about your mortgage and you're going to mortgage renewal or you're looking to get a pre-approval, what options do you select? And this is a question that's very difficult to answer because it always comes down to that individual, that family, their particular situation, on their risk appetite. Sometimes you'll talk to an individual and the one partner is a lot more advantageous. They want to take advantage of the market. They are more risk takers, and the other partner is, a little bit more conservative and reserved. So, that conversation between, do we go fixed, do we go variable, especially right now. There was a time where, as I said, as interest rates into 2022 started going up dramatically, that we would not even advise our clients into a variable rate product at that particular point. But now there's a big conversation. It's not coming from me, it's coming from many in the industry. And obviously, we would love to hear your thoughts on this. But as the market, many people believe that the Bank of Canada is about to cut rates. Do we get into a variable rate mortgage and ride the wave down? Or is the wave still going to continue, that tidal wave continue to rise, right? This is the risk. And especially if you're looking at a fixed payment variable versus a adjustable rate mortgage. Those are the ones where your payment remains the same, but the amount of principal and interest deviates, right? So if you're in a static payment with a fixed rate payment, a variable with a fixed payment, that payment will not change no matter what happens to the Bank of Canada. What does end up happening is that more of your principal ends up going towards, or that payment, I should say, goes towards principal rather than towards interest. So this may be a pressure relief valve for Canadians who are in these higher amortized mortgages that are seeing 40, 50, 60 years. If policy rate gets pulled back, now all of a sudden these mortgages may slightly realign. They're not going to fully realign, but the majority of those mortgages may realign. Many of those Canadians may opt to flip into a fixed rate mortgage where their amortizations may have to be pulled back. Maybe their principal and interest is going to be readjusted. Obviously, a lot is to see what is going to happen right now, especially when we look at what is happening with this mortgage charter, something we've talked about on the channel. As the ink begins to dry on this, we need to see how the banks are going to implement this. Is it going to be something that, as interest rates drop, what's going to happen there? So as we track what's happening with this mortgage charter, there's a lot of misconceptions, I should say, with this particular nuance. We get asked, hey, is this law? And I'm like, not yet. But a lot of banks, if you're in a situation, you do need to reach out to them. And then obviously we have the fixed rate components, as a lot of these Canadians who are renewing their mortgages sort of see that, hey, you know what, my mortgage is coming up for renewal in March or April or May. This is really good timing because fixed rate mortgages are dropping. So it's going to alleviate some of the pressure on those Canadians with those higher rates, right? Because when we were looking at rates at 6, 7%, and if interest rates drop lower, then, that payment shock might not be as great. And then, obviously this is great news. Let's blanket that and say, okay, this is really good news for Canadians with mortgages. A little pressure relief valve is going to hit in the next little while. But obviously, what does that mean for the Canadian real estate market? This is the $1 million question. What do you think is going to happen? I mean, generally, as I said right at the beginning, if interest rates drop, generally home prices jump up. If home prices or interest rates go up, well, then home prices tend to fall off. And we have definitely seen these prices fluctuate depending on the market that you're in. Obviously, if you're in some of these hotter markets, some of them have been impacted significantly. Some of them have not been impacted as much. Looking at Calgary, obviously it all depends on the market that you are looking to purchase in. But at the end of the day, I guess the overarching advice that we can give to many Canadians is get yourself pre-approved. Look at the options if you're thinking about buying a home in this market. And find out from yourself what your comfort level is, how big of a risk you are willing to take, especially with uncertainty with your potential employer. If you're working, if you're self-employed, think about what that business will look like 6 months from now, 12 months from now, a few years from now. And that should be your guiding light. You have to ultimately make the decision on your own. You should not be making a decision or pressured by someone to make that decision unless you're ready and able and confident in your decision to go out there and purchase a home. That is probably the best advice. No one should ever tell someone now is the time to buy. Obviously, that decision has to come from families. And I always say, if the media was today to come out and say, now is the perfect opportunity to buy a home, what do you think would happen with the mass consensus, the mass amount of people that are out there on the sidelines? I bet you, a couple bucks, that they will get into the market if they hear that coming out of the media outlets. But as I said, very, very important to understand what is happening right now. So we want to hear from you. What are your thoughts? What do you think is going to happen with the real estate market if interest rates drop? What's going to happen to the housing market? Are we going to see a boom maybe in the tail part of 2024 if fixed rate mortgages come down? How low do you think these fixed rate mortgages are going to go? Remember, these fixed rate mortgages, very dependent on the bond prices, but the bonds prices are moving with what's happening with the US Fed, obviously with the Bank of Canada, as the market prices in these rate cuts down the pipeline, it puts a lot of, or relieves a lot of pressure in these bond yields. So let us know what you think in the comment section below. And remember, if you're not subscribed to the channel, please do so for our weekly insights and tips and advice on what's happening in the mortgage and real estate marketplace. But we'll see you next week. And thanks for watching. Happy Friday, and wishing you a better weekend ahead.